Picture this. You open your laptop with a simple goal. I'm finally going to start investing. You search best investment options. Within minutes, you see hundreds of results. Index funds, ETFs, dividend stocks, growth funds, target date funds, robo-advisors, brokerage platforms. You open 3 tabs, then 7, then 12. 2 hours later, you close your laptop. You tell yourself, I'll research more tomorrow. Tomorrow becomes next week becomes next year. This is not laziness. This is psychology. And today we're going to understand why intelligent, responsible people delay building wealth, even when they fully understand its importance. And more importantly, how to fix it calmly and permanently. This is Money Science AR. Let's begin with something simple. In the year 2000, researchers conducted a famous experiment in a grocery store. They set up a table offering jam samples. On some days, they displayed 24 flavors. On other days, they displayed just 6. When there were 24 flavors, more people stopped to look, but very few bought. When there were only 6 flavors, fewer people stopped, but many more made a purchase. More choice, less action. This phenomenon is known as the paradox of choice. And it applies directly to financial decisions, because when it comes to money, the stakes feel higher. Choosing jam feels temporary. Choosing an investment feels permanent. Your brain treats these differently, but it responds to overload the same way. When options increase, mental strain increases. And when mental strain increases, action decreases. Let's understand what happens in your brain. When you evaluate financial choices, your brain activates areas responsible for risk analysis. It begins comparing potential returns, fees, risk levels, time horizon, market conditions. This requires cognitive energy, and cognitive energy is limited. After a certain point, your brain shifts into protection mode. Protection mode does not say, choose the best option. It says, delay the decision, because delay feels safe. But in long-term investing, delay reduces compound growth. That is the silent cost. There is another layer to this: fear of regret. When you choose one investment, you are rejecting dozens of others. Your mind imagines future headlines. What if that fund outperforms mine? What if I miss something? The more options you see, the more potential regret your brain anticipates. To avoid regret, your brain postpones commitment. Ironically, the attempt to avoid regret creates a larger one, because the biggest financial regret most people experience is not choosing the wrong investment. It is not starting early enough. Let's look at real data. Studies on retirement plans show that when companies increase the number of available funds, participation decreases. Employees are not irresponsible. They are overwhelmed. When faced with too many investment choices, many employees choose nothing. And choosing nothing feels neutral, but financially it is not neutral, because compound growth depends on time. Time is the most valuable asset in long-term wealth building, not precision, not timing, time. Let's make this practical. Imagine 2 individuals, both 25 years old. Both plan to invest $500 per month. One begins immediately using a broad, low-cost index fund. The other spends 1 year researching the optimal strategy. Assuming a steady long-term return, the person who started immediately ends up with significantly more wealth decades later. Not because they were smarter, not because they found superior returns, but because they respected time. In investing, early action matters more than perfect optimization. This is a principle many people intellectually understand, but psychologically struggle to apply. Now let's explore something deeper. Why do we believe more information will create clarity? Because information gives the illusion of control. If I analyze enough data, I can eliminate uncertainty. But markets are inherently uncertain. No amount of research removes uncertainty completely. What research can do is identify reasonable strategies. Beyond that point, additional comparison often increases anxiety rather than confidence. Long-term wealth is not built on certainty. It is built on discipline. There is an important distinction here. There are 2 types of decision makers. Maximizers aim to find the absolute best option. Satisficers aim to find a good option and move forward. Research consistently shows that maximizers experience more stress and lower satisfaction. In investing, maximizing often means constant comparison, switching funds, chasing slightly higher returns, monitoring daily fluctuations. This behavior increases mental noise. Satisficing, in contrast, means selecting a well-diversified, low-cost strategy and committing to it. It reduces stress, it increases consistency, and over decades, consistency compounds. At Money Science AR, we focus on systems because systems remove repeated decisions. A simple investing system might look like this. Invest a fixed percentage of income monthly. Use low-cost, diversified funds. Automate contributions. Review twice per year. Ignore daily market movements. This system does not require constant evaluation. It requires consistency, and consistency reduces psychological friction. Let's also address something many people do not realize. Financial media thrives on complexity. Daily market commentary, new investment products, emerging strategies. This creates the impression that investing is complicated, but complexity often benefits the industry more than the individual investor. Long-term wealth principles are surprisingly simple. Start early, invest regularly, keep fees low, diversify, stay invested. The challenge is not understanding these principles. It is resisting the psychological pull of endless choice. When you reduce options, something interesting happens. Clarity increases, confidence increases, action becomes easier. This is why limiting yourself to 3 options when making a financial decision is powerful. 3 is manageable. 20 is overwhelming. If you are choosing a savings account, compare 3. If selecting an investment fund, narrow to 3 diversified low-cost options. Then choose one, not the perfect one, the reasonable one, and commit. Another powerful tool is automation. Behavioral research shows that automatic enrollment dramatically increases retirement participation. When decisions are automated, emotional resistance decreases. Automation turns investing from a repeated choice into a default behavior, and default behaviors shape long-term outcomes. When investing becomes automatic, your emotional state matters less. You invest when the market is high, you invest when the market is low, you invest when you feel confident, you invest when you feel uncertain. Consistency replaces emotion. Let's pause for a moment. Ask yourself, is there a financial decision I have delayed because it feels complex? Opening an investment account, increasing contributions, consolidating accounts, choosing a simple portfolio. If the delay comes from lack of knowledge, learn the basics. But if the delay comes from too many options, simplify. You do not need every option available. You need a structure that supports action. Wealth building is rarely dramatic. It does not usually come from discovering a hidden strategy. It comes from decades of small, repeated actions. And small, repeated actions require low friction. The paradox of choice increases friction. Your job is to reduce it. Limit options, set deadlines, automate decisions, trust reasonable strategies, and focus your energy on increasing income and maintaining discipline. In long-term investing, good decisions made early outperform excellent decisions made late. That is not motivational advice. It is mathematical reality. If you take one idea from today, let it be this. You do not need the best option in the world. You need a reasonable option that allows you to begin and remain consistent. Wealth rewards patience more than brilliance. Reduce noise, reduce options, build a simple system, then allow time to work. This is Money Science AR, where we use psychology and science to build long-term wealth, calmly, intelligently, and consistently. I'll see you in the next video.